Hello everyone, welcome to the continuation of Forex Trading Basics Part 2 brought to you by the ES channel. It's basically for anyone that wants to get a quick and simple overview of the basic terminologies of Forex and get right on to trading Forex as I help you along your journey as I am a trader also. Today the overview is going to cover what a pip is, what a what is leverage, what is margin, what are lot sizes, and I believe you should be ready to start trading afterwards. So jumping right into it, what is a PEEP? A PEEP is also known as the price interest point, or some other definitions would call it the percentage in point. They are both correct. It is the change in price movement of a currency pair. So currency pair moves upwards or downward. How do we track it? We track it with what is called a PEEP. An example here is GBP USD moving from 1.12305 to 1.12345 rather. It has moved 4 pips and this is a buying scenario, so you want to buy, so it's the value of the pip is increasing. The opposite applies to selling, to a selling scenario. For JPY pairs, which is Japanese yen pairs, the pip is displayed in a different manner, having 3 digits before the point. As you can see here, 123.406, and it moves to 123.456. It has moved 5 pips. For pairs, excluding Japanese yen pairs, it's quoted as 4 digits after the point. 4 digits after the point. That's where a pip start. The fifth digit, some brokers they tend to ignore it or add it, but the fifth digit is known as a pipette or a fractional pip, so it's zero point 0.5 pips. But from right to left, number 5 is a fractional pip, 4 is a pip, 4 pips, 3 and 4 makes it 34 pips, 2, 3, 4 makes it 234 pips. Moving on, this is an example from the TradingView chart, and on the right hand side here you can see where the price of the pair is quoted, and any movement here you'll be able to calculate how many pips from this. Able to calculate the number of pips from the movement of price as shown by the price tags here. Moving on, what is leverage? Leverage allows traders to control a large position using a little amount of money, so helps to increase their potential return on investment. An example given is if you want to control a 10,000 position, the broker will set aside $100,000 from your account. So, and that is called a 1 to 100 leverage. So you're trying to control a $10,000 position using just $100,000. That is what leverage is about, using a small amount of money to control a huge position. And brokers offer various types of leverages ranging from 1:50 to 1:1,000. It is that crazy. But you should also know that as much as leverage can increase your returns, it can also do the opposite. It can increase your losses. It is a double-edged sword. That is very important for you to know. Next is margin. What is margin? It is the amount of money that you need to open a leveraged position. In the previous slide, you saw that the broker will take 100 dollars to open a $10,000 position. So that is what margin is. To be able to open more positions, you should have more $100 or more monies, and it is expressed as a percentage of the full amount of that position. It is a percentage of the full amount. Brokers will tell you that they need 2% margin or 1% margin to be able to trade with them or trade a certain pair. This is what is used to determine the leverage, if it's going to be, if the broker is offering you one 1 to 100, 1 to 1,000, or 1 to 500, as the case may be. Now we're going to talk about lot sizes. What are lot sizes? Simply, it is the size of a trade that you are making or taking on your trading platform. There are three types of lot sizes: standard lot size, the mini lot size, and the micro lot size. The standard lot size, it is the largest. It allows you to control 100,000 units of the currency pair you're trading. Mini lot 10,000 units, micro lot 1,000 units. So it means if that currency pair moves 10 pips in your favor using a standard lot, you would already be in $100 profit. Using the mini lot, you'll be in $10 profit. Using a micro lot, you'll be in $1 profit. That's all you need to know. And this is an example of where you impute the lot sizes on the most popular platform, MT4, MT5. You impute the lot size you want to use to trade. And I could bore you with all the jargon of how to calculate the dollar value, which is here. You can find them on various platforms, but I want you to get this information as quickly and as easy, as clear as possible so that you can start trading. Now, do you think you're ready to trade? Forex trading has to do with coming up with a strategy, and that strategy, it's all encompassing, but here I'm trying to, I will break it down a little bit differently. The strategy could be based on fundamental analysis or technical analysis. Fundamental analysis has to do with, economic news coming from different parts of the world, the currency pair you are trading. Technical analysis has to do with you just observing the chart using trend lines, using candlestick patterns, chart patterns, price action, and all of that. Your strategy would help you know how to enter a trade, why you will enter a trade, and why you should exit a trade. So, why you should enter a trade or why you should exit a trade, and also the risk and money management, the money management and the risk management involved. But I am splitting it out here to bring out the risk management because the risk management is actually very key. Strategy is 10%, risk management is 90% because forex trading is all about probability. So you need to be able to manage your risk so you'll be able to stay in the game long enough to take advantage of the very good trade setups that could earn you the hundreds of thousands and the millions of dollars to make you that successful trader. You have to know that a whole lot of traders, about 80% of traders, they lose their money and they are not successful. What that what the remaining 10% have in common is that they know how to manage their risk. So it's very important. A bonus for this video is going to be about candlesticks. This is the most popular type of chart you would see traders use to be able to analyze the market. Candlesticks are here to tell you how the market is moving. You have a bullish candle and you have a bearish candle. As you can see in the bullish candle, it opens lower than it closes. So it opens at a low position and it closes at a higher position. Whereas a bearish candle opens at a high position and closes at a low position because it's bearish, it's going down, it's bullish, it's coming up. There could be any color, they could be the same color. However, most persons like to have their bullish candles as green and their bearish candles as red, but that's what you need to know. After that, it's time for you to download MT4 or MT5 on your smartphone or on your PC or Mac and open a demo trading account. I will leave the link to download the MT4 MT5 software on your device in the description box. So let me know if you have any questions, comment, drop them in the comment section. Do not forget to like this video, subscribe if you find it helpful. I am going to be dropping more YouTube shorts as I've been able to finally pass my phase 2 MFF challenge, and I'm going to get funded on Monday. Today is Saturday, 16th of December 2022. So fingers crossed. See you in the next one, and thank you very much for staying till the end. Ciao.